Ladies and gentlemen who are present this afternoon here, a very good afternoon to all of you. It gives me great pleasure to be part of the BFSI Insights Summit that is being hosted by Business Standard as we approach the end of an eventful financial year. Just as we were getting back to full normalcy, the world, we believe, had moved back to normal. News now comes that the new strain is appearing to be dangerous. With renewed hope that this strain weakens, let us take few steps towards 2023. The preamble of SEBI describes the basic functions as to protect the interests of investors in securities and to promote the development of and to regulate the securities market and for matters connected therewith or incidental thereto. SEBI's regulatory jurisdiction extends over listed entities, intermediaries, and persons or entities associated with the securities market, and hence its responsibilities weigh in each such bucket. SEBI has been a reform-oriented regulator in tandem with the development role enshrined in its preamble. This year has been no different from the past. Let me begin to outline recent reforms. I'll be talking about some numbers, some statistics. First, on the equity side, the amounts raised through equities during 2022-23 are quite low as compared to the past financial year. In financial year 22, we had total raise of about 1.39 lakh crores, comprising of 1.12 lakh in the IPO and FPO side and 26,000 on the right side. This year, as I said, a little subdued. 42,000 is what has been raised through IPOs and about only 1,200 from the rights issue. On the debt side, after seeing a high of 7.8 lakh crores in FY 2021, that was mainly on account of TLTRO, low rates of interest, liquidity, so on and so forth. This year, so far, we are down to just 3.15 lakh crores. We are still yet to see the last quarter, which is supposed to be most active, but we do think that the total raise in equity will be around 5 lakhs. The amounts raised, as I said, in both equity and debts have taken a dive because of multiple factors, including geopolitical events like Russia-Ukraine war, etc. It's heartening to note that the number of demat accounts have crossed 10 crore. Though it is a far cry when you compare it with the number of savings bank accounts that you have in the country, which is 150 crores. The very fact that it has grown over the past 2 years for us is encouraging. The number of unique investors have also increased from 3.6 crores in November 21 to 4.37 crores in November 22. On to the major reforms. I'll start with the mutual fund space. So very clearly, as all of you know, in November, the AUM of mutual fund industry crossed 40 lakh crores. This is a phenomenal number. So let's think about it. 5 years back, we had just crossed 20 lakh crores. So in 5 years, we've seen a CAGR growth on a simple basis of around 20%. And look at the SIP numbers. Last month, we saw 13,307 crores coming in. And I was talking to one of the CEOs, and just think about it, 13,300 crores in a population of 140 crores gives us, on an average, 100 rupees per investor, per population, per capita, per month, right? And this has brought about stability into the markets. What should be a number that you dream at? In 5 years, if we can touch $5, you'll say, why am I talking about $5? 100 rupees translates to $1.2. So if this becomes 5, the SIP number that we are talking about in 5 years can possibly hit 50,000 crores. These are the numbers that we talk about, and it is possible to achieve that on a monthly basis. Look at the numbers again. In financial year, about 5 years back, when the AUM was 20 lakhs, the AUM to deposit ratio was 18. Today we are touching 23. The AUM to GDP, which was 12, has now touched 16. Global average is 60. So 4 times that, and you can very well imagine the potential of the mutual fund industry. So looking at this growth, looking at the fact that money cannot be misutilized in the mutual fund industry, the fund management and all the processes today have been strengthened. We have brought about significant changes in the way mutual funds are run. I'd just like to highlight these to you. We have reduced the time period for redemption and payment of dividend in mutual fund units. Guidelines have been strengthened to develop the passive debt funds. This also includes issues like the Bharat bond, so on and so forth. And we want more funds to come into government securities and SDLs as underlying index constituents. We've introduced performance benchmarking. We've introduced MF units for prohibition of insider trading regulations, discontinuation of pooling of funds and securities for transactions in mutual fund by intermediate entities, which means brokers and MF distributors, uniform stress testing norms for open-ended debt schemes. Recently, in the board meeting that concluded day before yesterday, we've also launched the platforms for investing in direct plans. So this part of the capital markets, we believe, will grow. Good way to start as far as investment is concerned. In the mutual fund space, things have gone about pretty well. After intensive consultations, we did, if you recall, bring down total expense ratios, come to a trail model. I think all of these initiatives are helping the markets. So if you have a good distribution, the distributor recommends and advises a customer well over the long run, he earns more money, the investor gains, and the trail model actually helps. The reforms in the portfolio side, based on past experiences and learnings, SEBI has taken the following policy initiatives with respect to the portfolio managers: enhanced prudential norms for portfolio managers regarding investments in your own associates, related parties, and the minimum credit rating for all investments by portfolio managers, strengthening of policies and systems for fund management, including order placement, execution, and trade allocation by portfolio managers, and enhanced requirements for performance reporting and benchmarking by portfolio managers. The above measures are intended to facilitate enhanced disclosures for investors, which will aid in better investment protection and development of markets. PMS, we think, can compete with mutual funds too. To provide greater investment flexibility to managers of AIFs and to facilitate deepening of the domestic corporate bond market, we have decided to permit AIFs to participate in credit default swaps, not only as protection buyers, but also as protection sellers. subject to conditions. SEBI has also recently formed a working group to look into matters relating to credit default swaps, including implications for mutual funds. We think reform in the CDS market will help the bond market to grow as well. Let me turn to the bond markets. Over the past few years, the bond market has emerged as an alternative to the banking sector, especially for top-rated firms. There is need for mobilization of funds from the corporate bond market as it provides an alternative source of finance and supplements the banking system to meet requirements of the corporate sector to raise funds for long-term investments. To my mind, it also reduces the risk to the banking system. It is believed that this segment acts as a stable source of finance when the equity market is volatile and also enables firms to tailor their asset and liability profiles to reduce the risk of maturity, etc. Deepening and developing Indian corporate bond market has received close attention, and much of the changes will take effect from the 1st of January 2023, which include the threshold for bond issuances in electronic bidding platform, which has been lowered to 50 crores. This started at rupees 200, then brought down to 100. This will now bring it down to 50, so you're getting more transparency over there. Issuers can also reserve up to 30% of the issue size to anchor investors. The face value and trading lot has been lowered from 10 lakhs to 1 lakh to increase investor participation and ensure liquidity in bond markets. Brokers in debt segment have been permitted to place bids in the RFQ on behalf of clients. Earlier, this was only on proprietary basis. Online bond platforms have been brought within the regulatory ambit. They have to be registered as brokers, and in the debt segment, we hope that with these platforms, the participation of retail investors will go up. The timelines for private placement of debt securities has also been reduced from T+4 to T+3, enabling issuers access to faster money. The cap on ISINs will also reduce fragmentation and enhance liquidity. On the sustainable finance side, the increased interest in sustainable finance in India as well as around the globe, and with a view to align the extant framework of green debt securities with the updated green bond principles recognized by IOSCO, SEBI undertook a review of the regulatory framework for green debt securities. Based on the review, it has been decided to enhance the scope of definition of green debt security by including new modes of sustainable finance in relation to pollution prevention and control, eco-efficient products. We have introduced the concept of blue bonds that relate to water management and the marine sector, yellow bonds relating to solar energy, and transition bonds as subcategories of green debt securities. SEBI will also specify the basic do's and don'ts relating to green debt securities to address issuers against greenwashing related risks. These were discussed in the recently concluded board meeting. We don't want any problems here in the future. So in letter and spirit, we expect the issuers to follow guidelines and do not misrepresent. On the REITs and InvITs, with the introduction of REITs in India in 2014, SEBI provided an avenue for investors to participate in real estate and infra sector while affording the developers a mode for monetization of their assets. Freeing up developers' capital is also expected to bring in more investments in real estate and infrastructure. The government announced a monetization of assets program of 6 lakh crores to be done by PSUs through setting up of InvITs. Further, recognizing the need for debt finance of REITs and InvITs, the government has proposed amendment to various laws and recognized the ability of REITs and InvITs to borrow and proposed a framework for enforcement of debt contracts entered into by REITs and InvITs. It's early days, but as far as InvITs are concerned, today we have 13 InvITs and 3 REITs, which have raised more than 1 lakh crore from the market. Assets of more than 2.2 lakh crores are today held in these trusts. There were some teething problems initially, which have been resolved, and various aspects of the issuance, listing, taxation have been clarified and rationalized. As public money is involved, and with the lowering of minimum investment and trading lot for InvITs, we expect to see large participation from investors, especially small retail investors. REITs and InvITs is an area of continuous focus for SEBI, and we'll continue to work on this to improve market access for retail. We will continue with a view to keep regulatory objectives and business imperatives on an even keel. Municipal bonds. SEBI issued municipal bond regulations to provide a regulatory framework for governing issuance and listing of municipal debt securities. The numbers not very encouraging. Only 8 municipalities have raised 1,690 crores through municipal bonds. Recently, in November, Lucknow Municipal Corporation raised 200 crores through such an issuance. We are in consultation with municipalities, investors, and market participants to provide for changes related to definition of issuer, preparation of accounts, facilitating ease of issuance, provision of escrow mechanisms for repayment of debt. SEBI has embarked on an outreach program to reach out to municipalities across the country to use the bond market route to tap bond markets. SEBI recently clarified that municipalities can issue green muni bonds to facilitate them to tap sustainable finance. On the equity side, we have made changes to the IPO valuation norms. SEBI has prescribed adequate and sufficient disclosures about key performance indicators. Disclosures on KPIs has been introduced to enable investors to evaluate on same parameters as pre-IPO investors. Disclosures of weighted average cost of acquisition by promoters selling shareholders ensures information symmetry to public at large. The buyback through stock exchange route is being phased out in a gradual manner. The minimum utilization of the amount earmarked for buyback through stock exchanges has been increased from existing 50 to 75. A separate window on stock exchanges is being created for undertaking buyback. On buybacks, we want complete transparency. So in the recent changes that we've brought about, the reduction in timelines for completion of buyback by 18 days by removing the requirement of filing draft letter of offer with SEBI and its observations thereof, and reduction of the duration of tendering period and period available for payment of consideration to the shareholders, permitting upward revision of buyback price until 1 working day prior to the record date, making it mandatory to place the relevant advertisements documents with respect to buyback, such as copy of public announcement, letter of offer in the respective website of stock exchanges, merchant bankers, and the company for better dissemination of information to shareholders. These amendments aim to streamline the process of buyback, create a level playing field for investors, and promote ease of doing business. This will help existing shareholders in buybacks to a very, very large extent. We've also made decent amount of reforms for the broking community. Certain stockbrokers in the market handle a very large number of clients, very large amount of client funds, and trading volumes too. Possible failure of such brokers has potential to cause widespread impact on investors and reputational damage to the Indian securities market. To mitigate this risk, SEBI would be designated such stockbrokers based on identified parameters as qualified stockbrokers. We think there are 16 in this category. QSBs would need to comply with enhanced risk management practices and requirements. There would be enhanced monitoring of such QSBs by SEBI and market infrastructure institutions. It is pertinent to note that after seeing around 30 brokers default in the past 2-3 years, SEBI has brought in new 30/90-day settlement rule in India's stock markets, where brokers are required to transfer unused funds back to client accounts at least once a quarter. This resulted in brokers returning 32,000 crores to investors in one day in the first week of October. All this happened seamlessly. This is something unprecedented. Thus, SEBI looks to understand risks, and it was essential in this case to ensure that the cash securities do not lie permanently in the hand of the brokers. To conclude, SEBI will continue to reform the capital markets with pro-business and investor-friendly measures. Increase in SIP numbers, AUM, the market capitalization, so on and so forth, are positive numbers indeed. SEBI would like to have informed investors in the market because that is how markets can grow. We want long-term investors to celebrate the India story. We also understand that it is difficult to be ahead of the market as far as regulation is concerned, but with data and through the consultation process, we will make changes to ensure that the securities market runs smoothly and are safe for investors and meet all challenges. We will leverage technology, we will leverage data, because digital is the way ahead. Thank you very much for this opportunity. All the best to all of you, and a very happy and prosperous 2023 to all of you.